What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, first quarter AMC earnings are out. We're going to go over what was inside the report, talk a little bit about where AMC is not only headed in the short term, but the long term. I want to highlight a couple things that, one, stood out to me, where I see some progress, and obviously where AMC is still lagging. Just give you guys a big overview of what exactly has happened. Before we get into it, guys, if you did not see my latest video, the algorithm that I've talked about in other videos as well as tweeted about is finally finished and has been released. It's something I've been working on for quite some time. So if you're interested, you want to take it for, a 7-day test ride, see if it's something that you can add as a tool to your arsenal, see if you're, it's a right fit for you. I would love to be able to share this with as many people as possible. If it's not, that is totally okay. Like I said, I'm just trying to help as many people as I can and just really make sure that this is something that can help you. So come check it out. First link in the description. We did have a couple good trades early on. The first one was Microsoft, which was alerted about 9:57. And then we also took Amazon, which came through at about 10:12 as of today. It was a nice long move to the upside. Actually, Amazon triggered a short to the downside. And then Microsoft was the same one. This was a beautiful move right off of pre-market. It's got to load really quickly. It came right through at 9:57, even though this long, there it goes, now it's showing, guys, came off of this. Now we're starting to get into this chop period, okay, which is where the algo really gets into the micro scalping. Now these all get triggered, but personally I don't like to trade these moves. I think a long came in right here. It's taken a minute to load. Trading views lagging on me. Yeah, it did. I'm not really interested in these micro scalps. Some people get the scalp for pennies, especially if you're playing the indices on the 0 days. I like to wait for the bigger moves. QQQ just moved away a little bit too quick. I don't think it got the pullback that the algo was waiting for. But we did have some nice moves. So like I said, guys, if you're interested, come check it out. Take it for a test drive and see if it can be useful to you guys. So let's get into AMC. So I'm sure many of you have already seen some tweets, listened to Adam Aaron talk. Movie theaters are coming back. Revenues were up 21%, and as well as the amount of people that went to the theaters, I think, was up 21% when comparing quarter over quarter. The biggest thing that stood out to me very quickly was the net loss improved by 109 million to 235. So that's a pretty good increase, okay? And we see that right here. That net loss was about, I want to say, probably about a 30% change, which is really good, especially only on 21% in gained in revenue. It shows that they're operating a little bit more efficiency. They did close down some of their theaters. As you can see here, they have just under 10,000 screens, when here they had about 101 more screens, which is about a 1% change. So they did get rid of some of the baggage that was holding them down. Now he talks about how they had sold more ape units in order to raise capital. Okay, they repurchased some of their senior notes and had restructured some of their debt as well. Now that's what I want to get into, talking about their debt, and we're going to go through some changes that were happened quarter over quarter, and then we're also going to take a look at last year just to see kind of where things are going. So take a look at this line right here. It says corporate borrowings. That's their debt service, currently sitting about $4.9 billion, which is down almost about $260 million quarter over quarter, right? So this is not year over year, guys, like some of the previous numbers I was talking about. I'm sorry, yes, which quarter over quarter. This is over the last quarter as of the end of December 21. So we've seen a $260 million decrease to their debt service in a short period of time. Very, very good. Comparing that even previous, going back to the end of 2021, now we're down about $600 million on their debt service. Okay. So this is where, and I'm sure you can imagine this, with, yourselves, if you have credit cards and so forth, this is where companies really run into trouble. It's when we rack up too much debt, okay, which is kind of exactly what the Federal Reserve has done, and obviously our economy or our government. But when you rack up too much debt, that the amount of interest you're paying on that debt just becomes a huge percentage of your total revenue, and you get into that hamster wheel where you cannot get yourself out of, right? And this is where COVID really accelerated these things. The big change that I saw was the cash and cash equivalents. Okay. Now, Adam Aaron did throw out this, $700 million number, which I think is, untapped or it's a little bit different. But when you're looking at this line specifically, cash and cash equivalents, right now it's sitting about 500 million. Okay, so that change is down about 130 million. You're going back all the way to the end of 2021. That was at about 1.6 billion. Okay, so they're still obviously burning through cash. Now I've restructured some of their debt, paying down some of that interest, which is great, but they're burning through cash a little bit quicker than I guess I would like to see. Okay, that monster cushion isn't there. So seeing the urgency, right? Seeing some of these numbers and then going back and remembering and seeing the urgency of Adam Aaron of trying to release more of these AP units and talking about raises capital. Well, this makes sense. Okay. Obviously, dilution of a stock is not good for shareholders. Okay, which is us. So we have to think about that first. But when it comes to the company, he's burning cash a little bit too quickly, right? And I think that's where obviously why he wants to be able to raise it as quick as he can. So that part, seems to just really make sense. If you want to take a look at, I'm going to dive down a little bit further and show one last thing right here. And this is where rising interest rates and just the way that corporate debt is restructured, the way it rolled over, changes was I want to say every 3 to 7 years, but a majority of corporate borrowings are anywhere between 5 and 7 years the way it rolls over. It's the same thing with commercial real estate. If any of you guys are in commercial real estate, it's much different than residential. But anyways, let's just talk about this interest expense. Okay, so we have a little bit smaller of a debt service, but you have your interest expense going up. Okay, and this is quarter end, right? So this is just over the last 3 months. When you go all the way back to, I gotta scroll down a bit for you guys. When you go all the way back to the year end of December 31, obviously this is over 4 quarters, but we're sitting at, if you divide this number by 4, we're sitting at less than 100 million per quarter, right? In for the average of 2022, and obviously that was over about 115 million per quarter in 2021. So their interest expense overall is decreasing a little bit, but it's starting to slowly see a kind of a little bit of an uptick, right? So you're seeing their overall debt service number, which I just showed you guys, is going down. It's at just under that 4.9 billion from all the way where it was about 5.4 billion. However, their quarterly interest expense is still kind of sitting around the same point. It's a little bit less, 100 million. It was at 115 million, even though it did bounce down to 92 million. It's still kind of sitting up there. And obviously they're seeing, the rising interest rates, and the way that debt is rolled over, and the way that they pay on it is kind of still, struggling. It's still hurting them. And it's, $100 million in a quarter, it's just strictly going out, out of their revenue, you know what I mean? To be able to service some of that debt. So the quicker they're able to service it, and like I said, guys, the pace of the payoff, right? If you take a look at it, and I'm not going to scroll back down, but if you take a look at where they were at the end of 2021, sitting at $5.4 billion in, debt service, okay, right here, end of 2021, and now they're sitting at about that 4.8. At the speed of which they're paying it down, it's going to take quite some time to be able to really get it down. Now, once, if they can get that debt service, that interest service, okay, down about 50 million a quarter, well, then that's when they can really start picking up, the amount of payments that they, pay out against their corporate borrowings, right? Think about it like I said, a credit card, guys, and the way you have that minimum payment, and then as slowly as that balance, stays down, as long as your monthly payment stays constant, less of it will go towards interest. It's the same thing here. So let's take a really quick look at the charts, just quickly. I'll get this off for you guys. Take a look at the charts. One thing that did stick out to me watching AMC was kind of just seeing where it stagnates. So it's kind of been fluctuating around this $5 price point, which we've seen for quite some time. Obviously, we had that massive pull all the way down to the mid threes, when everything was going on with APE. It kind of bounced back up, got a little, and then really found itself back at that $5 price point. And then we got that earnings grind, right? And we've seen this for quite some time, where it's that slow grind all the way up into earnings, right? And then earnings come out, and nothing is crazy, nothing's wild, then it kind of sells off. And then you look at it kind of intraday, and you're kind of seeing this pop down a little bit, but slowly started to recover. Now we're hanging around $6. Like I said, it's very common for us to get that grind into the earnings and then kind of slowly start to sell off, but it is holding up very well. And one thing I will point out, and I did talk about this with everybody inside the group, is you take a look at IWM, which is, the Russell 2000, and kind of just how weak it has been, especially compared to, I mean, look at this is a very weak chart, making lower highs. It's kind of got this this support sitting really between this 170, I would say like 170-ish, 172-ish. It's got that lows of that 164, but it's just kind of really breaking down. And then you look at the inverse, you look at the SPYs and Qs, the rest of the kind of market, which is really being held by, 5 individual, big stocks, Apple, Microsoft being 2 of them, and it's showing a much different pattern. So the Russell 2000, your small caps have been really beaten down, and AMC comparatively on a medium to short term time frame is holding up very well. So it'll be interesting to see, obviously, once they start to bottom. I do find many times the way these cycles go, it's just the large caps are the last one to fall, your high growth and your small caps are the first ones to fall. So therefore they're the first ones to recover. So it'll be interesting to see how this plays out. But guys, that's it for this video. I'll see you in the next one.